Good day to one and all. This is Dr. Sivaraman of IKnowIndustries.com. So today I'm going to present the Asian session live market analysis explaining the derived forecast for this particular week, 27th April to 1st of May. So this is the tag end of the month and also the starting of the new month. So we anticipate the monthly trend reversal moves. So during such time, in a week, when the month gets over and the new month starts, then the volatility will be relatively very high when compared to that of the weeks wherein the month gets over and the new month starts in a new week. So instead of 2 weeks or 10 trading days, they will try to squeeze all and try to handle the derivative market within this week of 5 days. So obviously they have to handle the derivative market on the extremity, on the highest side and the lowest side. They have to hit the stops during this particular time frame, 27th to 30th of April. Then on 1st of May, they have to set either the high or the low. Then subsequently in the following week, they will try to make the opposite side in the market. Suppose they set the high on 1st of May, then the low will be set during the following week, and afterwards they will try to make the trending move. So this they do it mainly in order to handle the derivative markets. In the derivative markets, you know that the options, for example, like the put option on the call option, the put option will be at the lower level, the call option will be at the higher level. So normally, if you try to sell at the lowest level, the premium will be very less, or sometime it might be available in discount. Similarly, if you try to buy it at the highest level, the premium will be very less. So the traders who have got less equity, or the funds which have got the equity but they wanted to have more leverage, they go in for such options, so that automatically when the market moves against them, the position will be closed, whatever the premium they have paid will be absorbed. And if it is in the money, then they will be able to make huge profit on that. So normally during the month end and the new month beginning time, the players handle such trades of the options and the futures. And that is why you come across big volatility during that of the month end time and the new month beginning time. They have to set the highs and the lows for that month in order to induce the traders to take the positions accordingly. So what we normally assume as impossible, they will try to show that during such time. And that is the trick of the trade. So here you find that after handling the spot market, they also handle the other derived markets. So all the other derived market, they are all related to that of the spot market, and the other derived market are like that of the futures and the options, and also the CFD, and you come across the bank offering certain instruments like the forward covers, etc., all are based on the spot market. And so they make the quick moves in this spot market. So we need to understand that. So it is not that technically they are going to make a rise or technically they are going to make a drop. So if all the traders, when they gain the level, if they hit the stops on the higher side and turn long, then automatically there is no point in rising further up. They will make a drop and hit the stops on the lower side of the long holders. So it is a game wherein both the long holders as well as the short sellers are going to be trapped. So we need to understand the limitations of the market and then try to trade. So it is the last week of April, so trend reversal time. So the market is expected to make quick volatile moves. So what are the moves we expect on the 5 days of this particular week? So today they are expected to make a dip and firm up move during the Japanese session, and then they are expected to make one small firm up move and then slide during the European session. US session we could be able to see the swing and rise move. Then again tomorrow they will make the high level swing and slide during the Japanese session. So if you understand that they will be trying to make the upward stop and the downward stop and widen the spread in this particular week, day by day or session by session. Then afterwards they will try to go in for a swing and rise move during the European session, and then small firm up during the US session. Then afterwards on midweek, 29th of April, they will try to make one quick rise and try to hit the stops on the higher side and then start making the slide and small firm up in order to trap the short sellers who sell after the drop. They will try to firm up and then slowly firm up on the Thursday, and then they will try to make this big slides on May 1st. So you will come across that in this week they are expected to make the upward stoppment as well as the downward stoppment. As a result, the market is expected to be volatile. So this time frame is ideal for only session-wise swing trades. Session-wise swing trade. What it means? Suppose you wanted to take a position during the European session and close it within the end, by the end of the European session, it is session-wise trading. So around 7:30 to 8, you try to take a sell, and then before 13 GMT, try to close it with a profit. That is what it refers to. A session-wise trade. Otherwise, if the position is making profit, keep stop at entry and then try to trail the stop on the downside when you are short selling, and then you try to keep the limit order. During the gap time, they might fill and then start making the rise during the year session. So always after the slide, they will make a downward stop and to hit the stops of the recent buyers who keep tight stops and hit the stops and accumulate the long positions near that of the low and then start rising the market. After rise, they hold the high and accumulate the sell positions, and if the traders also take sell position, they hit their stops and then start making the slide. So that is what they do it during this particular time frame. So understand that the market is expected to be volatile, and you can watch the session wise swings in this derived forecast sheet, and the webinar is being recorded and you can just refer to it on a daily basis or make a note of it and or take a screenshot and then refer it as a guidance for your trading decisions. Next week, 4th to 8th of May, they are expected to make the trending move. But before that, they are expected to make the either way stop and move in a big way, because the month of May starts only on 1st of May, and since it is only one day, they will not be able to establish the high or the low, and also the prime data release, etc., are going to be during the first week. They will try to make the either way moves on the downside as well as on the upside. Then I will try to explain to you during next week on 4th of April, as of May, I will try to explain to you what sort of moves are going to be seen during the next week when the prime data release are going to be there. Now, these are all the levels in which the currencies are expected to swing during this particular week. So currently, Euro is trading around 1.0850 level, and they are expected to make one quick downward push to 1.0750 and start gaining the level above 1.10. And in the case of GBP, they are expected to hold around 1.50 and make a downward stop into 1.4950 briefly and then start gaining the level to 1.54. So you find that Euro is still below that of 1.10, whereas GBP has gained to 1.5152 area. So they are expected to make one downward push, because you know that GBP is the currency which creates the sentiments in the market. So once it is bullish, many traders try to take buy positions in GBP rather than Euro, thinking that Euro is fundamentally weak. Then they will try to make one quick drop in GBP using some excuse and create the bearish feel. And the traders holding long position in Euro will liquidate without making much of a drop. They will quickly absorb all the sells at the lower level and start gaining the levels in the case of euro. So that is why you find that GBP is the currency used by the players to create the market sentiment, because the volume of trades happening in GBP is relatively much less when compared to that of euro, so that they can spend less money and try to rig the market rather than trying to handle euro as a whole. Then in the case of yen, they're expected to make further downward move, and probably 117 they might be able to show that. So find that 119 they are just shown, but they will try to make one extended upward stop before making the downward move. And as you watch that, they will be doing the contrarian moves. Now you find that the moves are contrarian, like euro is a negative net change, GBP is a negative net change, whereas Australian dollar is a positive net change. Then you find USD yen, the denominator currency, is in positive net change, showing the USD gaining move. So euro and GBP are showing USD gaining move, USD yen is also showing USD gaining move, and CHF is showing USD weakening move. So that's sort of brief contrarian moves they are doing it. And in the case of Canadian dollar also, it is the USD weakening move, because they are just making a drop in the case of USD CAD. So whenever you find the currency, respective currency is in the denominator, when it shows negative net change, that means the currency is becoming stronger. Whenever the currency is in the numerator and the negative net change is shown, that means the numerator currency is weakened. So that is how, with the help of the live market code page, you can understand how they are handling the market. And it is not that they always make the USD gaining and the USD weakening move. They also do the contrarian move at varied degrees. Then in the case of CHF, you find that 9,500 will be the low, and then they will start gaining the level when euro is also gaining the level, in order to gain the levels in the case of euro CHF cross. Then in the case of Canadian dollar, as I was telling you, from that of 1.2728 area, they started dropping it, whereas euro has gained only 100, 200 pips from that, or probably 300 pips from that of the low. Whereas in the case of Canadian dollar, it has dropped in a big way from that of 500 to 600 pips. They are dropped it in the case of USD CAD. And that is the way they handle the market. And so we need to understand that the extreme bullishness and the extreme bearishness are short-lived in the market. They will only use that type of move to create the market sentiment, whereas they try to trap only the traders doing that, but they are not the sellers at the lowest level or the buyers at the highest level. So that we need to understand. But they will induce us to do that. So we should not get involved or become emotional and get trapped in during such action times. Then, in the case of Australian dollar, they are expected to go slightly below that of 0.78 and start gaining the levels. I mean, the Australian dollar could gain the levels in this particular week to 0.81 area. So these are all the levels in which the currencies are expected to swing in this week. And even though the market is expected to be volatile and they are expected to show some extreme highs rather than extreme lows. So far you have seen that extreme lows they are shown, but this time extreme highs they will show, but they will not sustain those highs. So you should be able to recognize that all quick moves are false moves in the market, and accordingly take positions. So here you come across the initial lows and the highs set around 3:30 GMT in the market. I noted down the initial lows and the highs, and now you can see what they have done it. With the help of the live market code page, they came down to 1.0847 in the case of euro, just about 5 pips drop below that of 1.0852 initial low, and then start gaining the level as we anticipate a dip and the rise during that of the Euro-Japanese session. So the high is 1.0878. They are not breached it. So you'll come across from that of the start of the late session, they will breach the high and go above. Then in the case of GBP, 1.5169 is a low. They just came down to 1.5166, start gaining the level, and 1.5187 was the initial high, and they just already breached. As you know, that GBP is the currency which is used to create the sentiment, which has gained back all the last negative net change and come to 0.0, and they will try to gain further up during that of the Japanese session. And in the case of yen, 118.78 is the low and 119 was the initial high, but they went up to 119.08 and come down. So it is a brief upward stop and start sliding it, and then they will try to breach it lower. So here you come up how they are showing the negative net change now in all. Whereas in the case of USD CAD and Australian dollar, they are showing the USD weakening move, but in the case of the majors, they are showing the mixed move or the contrarian move. So that shows very clearly that they are handling the commodity crosses to start with during the trend reversal. So during the trend reversal, they handle the commodity crosses followed by the commodity pairs, then yen crosses and yen, and the majors, finally the European crosses. So that is referred as the sequential trend reversal. Every time they do it in the same systematic way. If you know, okay, they are doing it in the case of commodity crosses, then they will come to that other commodity, big moves in the commodities. So you can take positions in commodities. Then afterwards, they will try to make big moves in the case of yen crosses. At the time, if you take positions in GBP yen and the Euro yen, you will be able to make good money. But when they are handling the commodities, if we try to take positions in that of the yen and yen crosses, you'll find it is frustrating. So understand in what sequence they are handling it and then try to take positions accordingly in those currencies. So the best way and the easiest way to find out is find the spread between the high and the low, which is more than 40 pips, and try to commit positions in such currencies. Then you will be able to see the quick profit. And in the case of crosses, when the spread between the high and the low is more than 70 pips, try to commit positions in those currencies. The selection of currencies should be based on that and not based on some data release, etc. Because many of the occasions, you know that you anticipated data release from UK and try to take some positions in GBP, and you may come across that the move may not be in line with that of your expectations, whereas the other currencies might have made big moves. So keep in mind, say for example, UK data, which is going to be released, for example, and the data happens to be negative, they may make a small dip in the case of GBP, whereas they will make a quick rise in the case of Euro. So that you should be able to understand what they are trying to do it. And afterwards, when Euro started gaining more levels, you find GBP also follows it on the upside. So the data release, that negative impact is discounted and the market follows the new trend. So that is how they make the market appear moving. So we need to read their intentions. Then you find fearless trade come in. Then in the case of Canadian dollar, 1.2150 is the low, 1.2191 is a high, and both are not breached. And 78.10 is the low, 78.35 is the 37 is a high. In the case of Australian dollar, they are not breached. So how beautifully they just done the brief downward stop and the upward stop in other majors, whereas in the case of the commodity pairs, they are not breached the high or the low. They are making only small swings now, and then they will make an outbreak on these currencies. So watch that and understand how we can take positions in the market. So what we do is, as a trading strategy, we read the market up to 3:30 GMT during start of the day during Japanese session in four majors and two commodity pairs. And if the market is near the high and not breach the high for more than 30 minutes of our observation after 3:30 GMT, then we try to take a sell position in order to quickly book profit during that of the slide. And otherwise, if the market is near that of the low and not breach the low for 30 minutes, that is up to 4 GMT, then we try to take a buy near that of the low. Then they will make a rise during late Japanese session. You can book profit. So that way, you can take a decision on the trading as small swing trades. But still, we have to always expect the unexpected in the market. So sometimes suddenly the data release may affect the market and make a unexpected move. So what we do is we try to keep a stop. So instead of stop, if we keep the sell stop or the buy stop or the hedge order, then what happens? If the market goes against, we might be hedged, and later on when we find that the hedging is not making profit for 10 to 30 minutes, we understand it was just done during quick stop and move. And then we close it with a nominal loss or with stop at entry and keep another hedge order to limit the risk. And once the market moves in our favor, we book profit in the buy side or sell side, whatever it is. So we initially keep the hedge order and afterwards we keep the stop at entry once the position start making profit and remove the hedge order. So hedging is used instead of stop. If the stop is used, the position is closed. Whereas if you use the hedging, hedge only limits our risk, but we hold both the buy as well as the sell position. If somebody says that holding buy and the sell position that means that you do not know how to trade, then we have to tell them that hedging is used to limit the risk either instead of a stop. And after about 30 minutes or 1 hour, we can take a decision whether the hedging was filled during stop and or whether the hedging was the right decision because the market is moving against us. So that we'll be able to understand and later on close the original buy position with that of the hedge, accepting 30 pips loss. Instead of the market closing your position, you can close it after understanding very well the market is going against. So immediately what your mind will say, take the opposite position. So try to take a sell position. If the hedging is making profit for more than 30 minutes, close the buy position with the original hedging, take a sell position in the market, then it makes more than that of the last money of the buy position. So you make a net profit. So there are various trading strategies available once you learn how to use hedging and how to perceive the market. So perception of the market is vital. Say for example now, euro is around 1.086667 level. So here you come across the net change is 9 pips. That means from when you compare it to that of the Friday close level, it is about 9 to 10 pips lower. On the other hand, if you look into that of the chart, you find the low which was formed around 1.0467 and compare 1.0865, it appears higher. Go to that of the high what was recently set 1.11, then you find it is lower. So it is only relative comparison. So when you compare it with that of the low, it appears high, it appears sharp. It is some 5 inches tall man. When he is standing next to the 5 feet person, he looks taller. Whereas if he stands next to the of a 7-footer, then obviously you look shorter. So it is called a relative comparison. So this relative comparison, we develop the market feel, whereas we have to develop the market insight, not the feel. The feel is emotional. The insight is currently the market is in this level, how far it can go down, how far it can come up. When you do the chart study, we are forced to compare it to that of the high. When you are taking high and the low set around 20 days back, 50 days back, 200 days back, etc. As a result, what happens? We develop the uncertainty. You just find out whether the market is going to rise from here so that I can take a buy position, or it is going to drop from here so that I can take the sell position. That sort of trading decision, if you want to take it, the ideal tool will be the live market code page, and find out how they are handling the market with the help of the net change, and then understand how to initiate the trades. Now, these are all the market timings, and many people think that the market levels are important, but actually the market timings are important. And invariably, the traders are all misguided by giving an alternative timing. They are all advised to follow their local times, and the traders can all expected to follow the different terminologies like the Asian session, then European session, UK session, New York session, etc. So that mainly is purposely given so that we are not in a position to understand how the market is being manipulated. If somebody is weighing their food stuff in kilograms, and a person who is known to understand only the ounce will not be able to understand on what basis he has done it. So if you also know the kilograms of the weight of the commodity, then when they say it is 1 kg, then you are able to understand. Instead, if you are used to use the ounce, for example, then you are not in a position to convert it on each time. Then you simply get confused. By the time you understand what it is, whether it is sufficient for your by requirement, etc., by the time you take a decision, the deal is concluded. So in the market, in the same way, they give the thing which you are supposed to follow and get confused. And the players use this particular time frame. So if you want to become a smart trader, you have to follow the timings of the big players. The timings followed by that of the big players, these timings are all derived based on the bank's opening and the closing in the international markets. So they cannot do anything artificial. They have to move in tandem with it of the international time. So as far as the international time is concerned, the players do not have any control. They cannot make UK to move closer to that of Europe, and they cannot move Japanese islands away. So they cannot. That is not in their hand. That is nature. The time and the time difference are all natural. So they cannot do anything. But what they do is they adjust their timings inside, so that before the banks open in the respective country, they try to make the stop-ins. Before the banks open in the respective country, they try to make the stop-ins. So the stop-ins are false moves. So always you find the quick moves are false moves in the market, and they try to do it mainly at the lower level in order to buy. At the higher level, the stop-ins are done in order to sell. So we need to understand, okay, whenever they are making a lower level quick move, that is a buy opportunity. Whenever they are making the higher level quick move, that is a sell opportunity. And that is how we try to identify following the times. So also keep in mind that they don't do hat trick. That means they don't move in a similar fashion for more than 2 sessions. If they rise Japanese session, European session, the third session, they will definitely make a drop. Similarly, they don't rise for more than 2 days. They don't rise or drop for more than 2 months. So keep these things in mind, and also understand that they are mainly making the moves based on the positions built up by that of the traders. If all traders turn long based on the bullish field created in the market, the players are not here to give the profit to them. Instead, what they do is they simply hold and reverse the market and hit all the stops and make their money. Okay. Let me answer to the questions which are asked here. And Oren wants to see the focus page. I'll show it. Okay. Then Sharon has got a question. What is appropriate time to enter trade? Is it the same as the market reading time? Yes, after 4:30 GMT, 3:30 GMT, that is from 4 GMT onwards, 4 to 5:30 GMT will be the gap time, I mean the mid session. So around 5 to 5:30 GMT, if you try to market timing, okay. Now 5:30 GMT is starting of the late session. Around that 5 and 5:30 GMT, observe for 30 minutes. If they are near the low, not breach the low, take a buy. If they are near the high, not breach the high, take a sell. Then you find by 7 GMT, they show you profit. And the gap time, they will continue it as a false move and they reverse the market. So that you try to use the trailing stop and capture the profit. Because see, our mind has got a limitation with regard to thinking. So the market moves are much faster in the electronic medium. So we have to use invariably the trailing stop to protect the profit. Yeah, this webinar is being recorded and you will be seeing it, which is displayed under the webinars heading submenu in fxtrade.com. Okay. Can I give you a forecast for oil, Daniel? Okay, oil, which is doing the lower level consolidation now with a frequent downward stop, and oil and gold, they are expected to continue to gain the levels slowly. And so normally what they do is once in a while, they make such lower level moves and lower level consolidation and accumulate the buy position, especially in the commodity market. When they hold it for 2-3 months, then those who have taken the forward cover have to forcibly liquidate their possessions. So those who have taken the physical delivery of oil in excess, they will just liquidate the long positions. So all deliveries the players will accumulate and afterwards gain the levels in the market and just distribute it at the highest level without having a rig to pump in the oil, without even taking any effort to find out where the oil fields are. The players can mint billions, whereas those who are involved in the physical oil extraction, they might come across extraordinary struggles in order to extract oil and try to purify and try to just process it and also pump and store it appropriately in the tankers and with adequate insurance so that if any calamity happens, they will be able to see that they don't incur huge loss. They do all the exercise. But the players simply rig the market on the upside and the downside and make much more than that of the oil extractors. This is not only with regard to oil and gold, it is also with regard to all the commodity markets. In all commodities, whenever there is the harvest season of a commodity like sugarcane or rice or wheat or whatever it is, they try to drop the market in such a way so that the farmers are forced to sell it with a minimal profit, or if they wait, they have to incur loss in selling the commodity. And afterwards, they buy all those positions in the market and also take the delivery of it and then subsequently stock them and then start gaining the levels to the extreme conditions and distribute it. And the entire world will feel the stock is not enough to have one meal. That is how they create the feel, and automatically the people are willing to buy at whatever the price they sell. That is how they inflate the prices of the commodities. But the governments are also part of this particular rigging. So the people who are in the government, they also enjoy the benefit out of that. So they don't also control it. So the common man has to suffer. But That is the way they wanted to earn money. So when the money has to earn big money, and they have to be cunning all the time. But the history says that none of the people who earned the money in a very cunning way had peaceful death on suffering than Chowkir. As the GBB has moved to the middle level trading zone, yeah, GBB they just come to the middle level and they will try to. No, it is not still middle level is around 1.55. Still in the lower level, they will try to make some downward stop and then move upward to the middle level. Then Stephen, what do you think by the price action in the GBP since the opening of this week? GBP, they have done only a nominal downward move and they will try to gain quickly in the case of GBP in order to create the market sentiment. Then Lam Shelley, how would the players make use of the UK elections to manipulate? See, normally you just refer to the previous elections, how they have done the manipulations, and you'll be able to understand they will make either way moves. No, you don't think that election outcome is essential. They will try to make either way moves, irrespective of the electoral outcome. And even if there is an election and if there is a US data which happens to be negative, then they will make one big upward rigging in the case of GBP in spite of that elections, etc. So don't give much importance to that of the data. You only give importance to that of the data release time. And every time you find the data is released and the hype will be there for a few hours. Afterwards, people will talk about the next data. Then people will talk about the alternate other data. And so it is only question of the trigger which are used. The data release is nothing but the trigger used by the other players in order to confuse the traders. There are so many times you come across the data is negative, and last week you know that GBP data was negative and they made a drop in the case of GBP and then subsequently started gaining the level and which has outperformed Euro. So don't give importance to that of the data, give only importance to that of the data release time. And that is vital. That they use it because they know very well after the data release, if the data is negative, the traders commit positions. After the drop, traders sell. Then you find the market drops. Then which triggers all other small traders to sell after the full drop. Then the players buy all those sells and hold the market in order to just induce the people to digest the data. Then later on, they talk about the next data which is going to be released out of US. What happens when the US data is negative? The GBP data was negative, so they dropped GBP. The US data is negative, so they gain levels in the case of GBP. In what way the negative impact created on GBP is nullified by US data? If you question it, then you'll understand it is nothing but the manipulation. So they're all called apparent evaluations. Let me give an example. Suppose you have $100 in a hand and you spend $10 out of that, you hold only $90. So you are weak by $10. And another friend who is having $100 were also spent about $20. Then he holds $80. Can I say that you are richer by any chance? You are holding $90, whereas your friend is holding $80. That's all after spending it. So still, for relative comparison, $80 and $90, 90 appears higher. But 80 is lower. But as far as the physical holding of the currency is concerned, You are only holding $90, less than that of 100 what you had, and that other person is your friend is holding $80, $20 less than that of the initial holding. And this is how the actual financial comparisons are done. But the apparent financial comparisons are the market perceptions. When your friend is holding $80, then if somebody says that you are richer by $10 than your friend, that it is nothing but the perception. Actually, not, you lost $10. So this is how they manipulate the market and give interpretations. And we think that that is real. It is very unfortunate. When is better to start the trade today? So since it is going to be the last week, they are expected to make the swings accordingly. It will be appropriate if you could do session-wise trade. So that is my humble suggestion. Then Sokip, can we expect drastic moves this week due to plentiful data and the last week of the month? Yes, obviously they will suddenly make an upward move and the downward move, but you come across the forecast sheet is giving the guidelines. So make use of it and then accordingly take positions. That might be able to help you in making profit. And definitely those who are holding lesser equity, avoid taking positions during the last week and the first week of the month, because the players are expected to make sudden knee-jerk reactions in the market, and by making extended stop and moves, so you should not get caught unnecessarily and lose all the small profit what you have been earning all along during trending time. So that is why, see, they alternate the trending with that of the trending, trend reversal. So people who get used to that of the trending, so they just follow the chart and commit, and later on find that they lost all the money. That is why you find 95% of the traders who follow the charts lose money in the market at the end. Do you think that USD CHF can go above parity? Yeah, USD CHF, they are likely to take above parity, but it will take time. They will just do it by May end or June. So this is the forecast sheet and also the levels in which the currencies could swing in this week is displayed here. One more question is coming in the question window. Okay, is there any seasonal variation throughout the year that we need to consider while taking positions? Yes, obviously, similar to that of the weather seasonal change, you do come across the volume variation happening in the market from time to time. And as a result, you find once in 3 months, the quarters, their seasonal variations. And accordingly, based on the variations in the volume and also in the derived market, the players make differential moves, especially during that of the yearly trend reversal time. They will make massive moves like 1,000, 1,500, 2,000 pips move. And during that of the monthly trend reversal, they will try to make about 300 to 500 pips, 700 pips, that sort of moves. So we need to understand how they are trying to make such moves that I extensively explained in my trading system webinars, which are recorded and displayed in fxstreet.net under my profile. So those who are interested can just go through that, and it is free, and find out how exactly you can understand the market and also understand the shift in trading zones. Okay, I've taken much time. So I take this opportunity to thank FX Street for the facilities provided and you people for your kind presence and also trying to understand the market so that you don't become emotional again and again and lose money and try to recover what you have lost. Then I'll come back on Thursday, 30th April month end, and try to review the forecast, what I have given it for this week, and find out whether the market has moved in tandem with that of the expected market moves or against, so that objectively we'll be able to find out whether the forecast is dependable. Then also still we use the hedging order trading strategy to limit the risk and maximize the profit. So thank you one and all. See you on Thursday. Wish you all happy trading and trade with common sense.